Ravi Jakhar, Chief Strategy Officer with Allcargo Logistics, joins us now. Ravi, good morning. Thank you for joining us. I'm just looking at the headline
Good
print
morning.
for Allcargo for the quarter gone, where revenues are down, EBITDA is down, profits are down, margins are down. Uh, why is that?
Yeah, so I'm happy to share with you the performance of the company. Uh, Naturally, from a global economic standpoint, this has been a very tough operating environment, and that is what has led to some decline in performance when you compare with the previous year. Having said that, the macroeconomic environment defines how countries or economies operate, but from a business point of view, how does a company respond to such environment? And in that context, if you look at our performance, we have outperformed the market both in terms of gaining market share, in terms of volume. If you look at the international forwarding community, most of the listed companies in Europe have reported up to 17% decline in volume. As compared to that, we have seen about 7% in LCL and almost 0% in the HCL business segments. If you also look at the performance in India, which is naturally not been impacted by the economic environment, there we have seen that revenues are of course down because there's a lot of ocean freight rates, which is a pass-through cost. But despite a 20% decline in revenue from the quarter ending December to quarter ending March, gross profits have only gone down by 2%. If you compare with the previous year, the revenue drop is even sharper because the ocean freight rates have corrected much more. But the gross profit, as I said again, has been down only by 2%. So this has been the template for us whereby we recognize that the ocean freight rates get normalized, but we are able to protect our margin, and the marginal impact on the profitability per unit is offset by the growth in volumes. So we believe that as the volumes come back in the international market, we should be follow the same template to drive back to the gross margins that you were reporting earlier. In terms of the margin percentages, of course, they continue to hold well because the revenue has also gone down on account of the ocean freight. So I would say that the company's performance has been impacted globally by the operating environment, but it has been extremely resilient and driven by our focus on technology and all the other initiatives. Our market share expansion and outperformance to competitors in larger, broader markets continues.
Sure, Ravi, point taken. But could you talk to us about the outlook? You explained what went by in FY23. Are you expecting at least some sort of improvement in FY24 with respect to ocean freights, volumes, etc.?
So ocean freight rates, we believe, will remain normalized at these lower levels, and we are not factoring in any increase in that. So revenues may not see a significant expansion, but as I said, revenues have a lesser bearing on our profits because a lot of ocean freight rates are pass-through cost. From a volume point of view, if you look at, we've also started sharing our quarterly as well as monthly updates on operating parameters. So we have seen that container utilization has gone down by about 6%. The share of 40-foot containers has gone down about 12%. Now these are the parameters driven by volumes. If you look at the April volumes, they seem to be lesser than March, but that is usually the trend. May seems to be holding back. So I would say that April to June quarter would certainly be higher volumes than Jan to March quarter, which means that it should allow us to have better operating parameters. We do not see a sharp recovery from at this point in time, but we see a sustained gradual recovery in the volumes, and we would try to top that up with expansion in the market share. So if you're able to get back to the volumes, the gap of about 8-10%, that would immediately reflect back because all of that is a straight pass through into the bottom line, and that's what we would be intending. So I would say hope for a gradual recovery, and that should improve the performance. And also just to bring to attention, there have been some one-off items as well. Settling in for some of the prior COVID period adjustments in US, which is like write-offs beyond 1 year, etc. Those would not be repeating in the next quarter. So from a reported number point of view, there's an estimated 68 crores in the quarter 4, which is towards such one-off expenses which are not to be repeated. So to that extent, you would see normalized profits in the coming quarter.
So now we're talking about the numbers for the quarter gone by. That's March end. We are 2 months in this quarter. What kind of a recovery, which you say you will see a gradual recovery, will we see in this quarter? Will there be a sequential uptick or sequential drop?
There would be a sequential uptick. That's what I was reflecting, that April to June quarter would see higher volumes as compared to Jan to March quarter. That trend is clearly visible, and we would continue to share the monthly updates on the same as well.
A drastic reduction in SG&A cost, because if you have to bring margins back, it could be a function of demand, which is gradual, but SG&A expenses are with you, which you can cut immediately.
So we have already been working on it, and these have been done through a sustained digitization initiative, and which is where we have seen some improvements already in the last about 2-3 months, and over the next 8 to 12 months, you would see sustained improvements on account of there are jobs which are being automated, there are jobs which are being outsourced because they have been now defined into a certain process whereby they can be moved from some high cost economies to low cost economies. For example, there could be about a good number of jobs moving from the Western economies to emerging economies, maybe 60 to 80 of those jobs over the next 8 to 9 months. In addition, there's a lot of technology initiatives as well. Taking one small example, a lot of quotations which come to us by email were earlier getting unresponded, which is loss of business and also unproductive manpower utilization. Today, thanks to tools like ChatGPT, we've automated those email responses. So a lot of those technology initiatives would continue to play out, and that is the way by which we would be able to, in the near term, I would say we would offset the inflationary increase in the SG&A cost by reduction in manpower through use of technology and better processes. In the long term, as the inflation rates stabilize, we should be able to control them further. And as revenue expands, the percentage margins could potentially improve on the back of that.
Okay, now the company also is in the process of acquiring a 30% stake from KWE. By when do you see that coming through? Can you give us a timeline, and what kind of incremental revenue and margin expansion do you see on the back of this?
So all the terms have already been agreed. The final share purchase agreement could be signed anytime in the next couple of weeks. So the way to look at the company, could be that Allcargo today owns 100% of the international supply chain business. It owns 100% because we have already bought the contract logistics partner that SPA is already signed. So now we own 100% of the contract logistics business, which is a very robust, healthy business with an EBITDA of about 121 crores, which is not consolidated again in the reported numbers because the transaction was consummated after the 31st March. So from next quarter onwards, you would see the contract logistics business also being consolidated. On the Gati side of business, as you know, the operating business sits under Gati KWE. Now Allcargo would own 30% directly with the SPA to be signed in the next couple of weeks and 35% through the 50% shareholding in Gati. So effectively, think of it as 65% of the express business, 100% of the contract logistics business, and 100% of the international supply chain business. On the express business, we would continue to see a gradual expansion in both operating margins and top line, which has been the trend in the last 2 years as well. If you look at the FY22 EBITDA was about 50 odd crores, FY23 has been about 90 odd crores, and we believe similar trends to continue because we are gaining market share and we are also improving the operating profit margins by way of infrastructure improvements, service improvements, and the operating leverage would also continue to play out in Gati. So on the international supply chain business, volume recovery, in the Gati business, operating efficiencies, and the now added contract logistics business, which was earlier a joint venture, would all add to the strength of the company in the quarters to come.
On that note, we let you go. Appreciate you joining us and talking to us about the outlook of the company. For now, the market continues to trade in the red, but in terms of stock specific